Most traders know about trend lines. In fact, they're probably one of the first tools people learn when they start looking at charts. But despite being so simple, they're also one of the most misunderstood tools in trading. The problem isn't the concept of trend lines. The problem is how traders use them. If you watch different traders analyze the same chart, you'll notice something strange. Everyone seems to draw their trend lines differently. Some traders connect the candle wicks. Others connect the candle bodies. Some draw extremely tight lines while others treat them like wide zones. So naturally the question becomes, who is actually right? And even after figuring out how to draw them, another problem appears. How do you actually trade them? Should you buy every time price touches a trend line expecting it to bounce? Or should you wait for the trend line to break and then trade the reversal? Over the years, I've tested both of these approaches extensively. I've taken trades on bounces, trades on breakouts, and even trades on retests. Some worked, some failed. But after a lot of chart time, I eventually discovered a much more reliable way to use trend lines. In this video, I'm going to break down exactly how I approach trend lines today. We'll cover how to draw them properly, how to avoid the common mistakes most traders make, and the two strategies I personally use when trading them. But before we get into the strategies, we need to understand what a trend line actually represents. At its core, a trend line is simply a visual way of tracking the direction of price movement. Markets rarely move in straight lines. Instead, they move in waves, pushing up, pulling back, pushing again, and repeating that process over and over. These waves create something called swing points. A swing point occurs when price moves into an area and then reverses away from it. If price drops and then moves higher, the lowest point of that move is called a swing low. If price rises and then reverses downward, the highest point is called a swing high. Trend lines are created by connecting these swing points. In an uptrend, we connect the swing lows. This creates an upward sloping line that shows where buyers are consistently stepping in. In a downtrend, we connect the swing highs, forming a downward sloping line that highlights where sellers continue to push price lower. Now you might be thinking, if the trend is already visible on the chart, why bother drawing a trend line at all? The reason is simple. Trend lines don't just show direction. They highlight potential reaction zones. When price repeatedly reacts from the same area, that area becomes important. A trend line helps visualize that pattern. It shows us where price has historically bounced and where it might react again in the future. But there's something extremely important most traders misunderstand about trend lines. Trend lines are not exact lines. They should be treated more like zones or areas of interest rather than precise levels. Markets are not perfect. Price rarely respects a level down to the exact pip or dollar. Instead, it tends to react within a general region. So if price slightly breaks above or below a trend line before reacting, that doesn't necessarily mean the trend line failed. It simply means the market tested the zone.